Today I'm going to talk about private equity and its cousin, private debt, because I believe these two things are probably going to be part of the next big economic crisis for us. Now, private equity is a term for companies that are not publicly traded or listed on any stock exchanges. If you're like most investors, you don't think much about this because it's just not available to you to invest in. But many private firms are local firms, too small to be listed on stock exchange, but with which you might work or might deal with every day. So their owners are private, and that's where the term private equity comes from. Now, some of the most visible private equity firms are things like Elon Musk's SpaceX, the Mars company that makes Snickers and M&M's candy, are all privately held. Love's travel stops. There's many thousands of others. Now, you can't buy any stock in these companies because they're private companies. And there's roughly 6,000 publicly traded companies listed on stock exchanges in the U.S. But Census.gov says there's about 5.5 million private companies. For every single company that's listed on a stock exchange, there's almost 1,000 private companies. So this is a big market. Now, I've been concerned for a number of years about the number of stocks shrinking as more and more of these are bought out by private equity funds, such as hedge funds and endowments. I'm going to just call them PE funds a lot during this talk, just to keep things simple. These transactions differ from something that a family-owned Mars company, for instance, might do, because Mars wants to keep its customers happy by making the very best products. PE funds, on the other hand, want to squeeze as much profit as they can out of the company in the short term so they can flip the company to another buyer at a higher price. If this short-term focus leads to longer-term problems, the private equity funds expects to be long gone. Now, this chart that is up right now shows the growth of the private equity industry over the last 23 years. And it's grown about 12 times in value than it was in 2000. This next chart leads me to some shivers down my spine because I read some recent articles that really bothered me. And one was when celebrities like Tony Robbins or Kim Kardashian start touting their own private equity funds to inexperienced investors. On October 3rd, the Wall Street Journal says Wall Street firms are now wanting to offer private equity funds to individual investors that are often unsophisticated. This condition is almost as alarming to me as it probably was in 1929 to Joe Kennedy when he realized that he needed to get out of the stock market before it crashed in October of 1929, when his cab driver began giving him stock tips. When he realized that when all the little investors, like his cab driver, were already invested and talking up investments, you run out of buyers. There's just no more buyers left after that. There are only sellers. And the markets are balanced between potential buyers and potential sellers. Running out of buyers is what makes markets crash. Now, when everyone from celebrities to rookie sports stars start touting private equity, I'm telling you, the last buyers are being drawn in. And this is a big problem. That second shiver down my spine was caused by some articles talking about the overvaluation of private equity firms. Fueled by cheap money during the low interest rate era we came through here the last few years, it was cheaper and less risky to buy companies with borrowed money than to start up a competing company. So PE funds were buying as fast as they could. And competition to find private firms became so intense that private equity funds began bidding up prices and distorting the market. Now, you'd think that professionals would know better, but these people are locked into this narrow market segment, and that's all they can look at. So they're forced to either buy high or stop generating fees for themselves. And which do you think they're going to do? They'd rather buy high and make fees and let you hold the bag later on. Now, they also began looking at more marginal businesses like dentist offices and car washes, hospitals, veterinarians, self-storage units, funeral homes, and these kind of things, rolling them all into their funds. But in doing this, PE funds have created a massive bubble in private equity values. Have you noticed in your town that prices are up and service levels are way down. This could be due to private equity firms owning more and more of these businesses. Newsletter writer Jared Dillon talks about private equity-owned nursing homes having a much higher mortality rate than publicly owned homes. CBS News warns readers, be scared after private equity spends $10 billion buying hospitals. We can see this problem these days in many, many industries. Now, most of these purchases are made with loans of up to 70% of the value of the business being acquired. And much of this is private, unregulated debt. And this created shiver number 3 for me because a collapse of the bond or the debt markets has the potential to make interest rates soar. And I'm guessing that interest rates will affect your life a lot more than the price of SpaceX stock. Holding periods are getting longer and longer for the private equity firms. This is the time it takes them to unload companies that they have bought. The fact that the time to sell these assets has doubled over the last few years, as this chart shows, means that private equity firms are already having trouble liquidating their holdings. When our economy softens and these private firms really begin to struggle, those lenders might decide they want their money back from these funds. Remember, there's no market for their underlying assets, and to sell them might take fire sale prices and a lot of time. We're already seeing the lot of time dynamic in this last chart, but fire sales also imply losses of maybe 50 or 70% of the value of the underlying assets. Now, private credit has been likened to the junk bond fiasco we had a generation or so ago because of the systemic risks to the economy a collapse in this market can cause. This is primarily because the equity in these funds is leveraged 2 or 3 or sometimes 10 times. Debt is being piled on debt upon debt and being used to amplify returns. This high leverage means small losses can wipe out the equity fund, forcing loans into default and paralyze our economy like we saw in 2008. And now we're in a position where many of us unknowingly depend upon private equity remaining a solid investment. This is because pension funds are invested in private equity. University endowments are invested in private equity. Banks are invested in it. Private lenders are invested in it. But the private equity funds' underlying assets are illiquid. And if there's a real downturn, there's little that they're going to be able to do to sell those assets. They're literally running out of buyers. Now, the demand for money can be measured in interest rates. Interest rates for these highly leveraged loans have nearly doubled recently, as this chart shows. Lenders are up to their eyeballs in PE fund debt, and they're already charging more and more to make new loans. Now, this may be the series of dominoes that I worry about starting to fall. As you can see by this next chart, about 88% of private debt is coming due and needs to be paid off or refinanced in the next 5 years, probably at new higher rates. The increased cost of interest is probably going to wipe out a lot of these firms if they can refinance at all. Failure to refinance all this debt could force these PE firms to start the fire sale and then Katie bar the door. The loss of equity in these PE funds is really not the biggest threat. The biggest threat to our economy is the underlying debt funding this market may be determined to be worthless. And that can be 10 times the amount of private equity. So we're just entering this really high risk environment. So as an investor, you need to buckle up and get ready for it. All it takes for private equity and private debt bubble to pop is a catalyst. And I can imagine the next stock market downturn where investors start asking really pointed questions of their private equity funds and perhaps asking for redemptions. And if these firms can honor redemptions, they're going to be forced to sell underlying assets at distressed levels to pay off their investors. Many won't be able to sell them at all. I mean, do you know anyone who has the cash to buy a distressed hospital or a car wash? Me neither. But much like the financial engineering that fueled the mortgage bubble in 2008, we're hitting what I think are peak levels in the private equity cycle. And an unwinding of this bubble is imminent, in my opinion. I don't know if it'll happen next year or a bit later, but when something simply can't continue, at some point it won't. And that point is coming, I believe. There are already cracks showing in the PE market, as I've shown you today. Investors start rushing for the exit. many of them will not be able to get out. Now, here at Shadowridge, we already have proactive plans for dealing with market collapses. And if you're not yet a client, I would suggest you ask your current advisor what they're going to do if the bond market collapses or the stock market collapses or the private equity market collapses, and see what they say. If they tell you, oh, don't worry about it, that'll never happen, or just hold on and be patient, I'm telling you to run. Do not walk out of their office.